The financing window has opened for companies in the junior mining and exploration space. So, are financings dilutive or are they accretive? Hi, George Sanders, President, Goldcliff Resource Corporation. Today we would like to share some thoughts and relay some conversations and observations regarding financing in the junior exploration space. Since the early part of August, the number of financings and the number of companies receiving financings has steadily and dramatically increased. Goldcliff has been one of those companies. We recently completed a financing and very recently just announced a second financing, the details of which are available on our most recent news release and on our website. And as a result of that, I've had many discussions with the investors, with stockbrokers, with market influencers, with shareholders, and with prospective shareholders. And I wanted to address this issue of dilution because it comes up in all of the discussions. The investor, the stockbroker, the influencer wants the particular public company driving forward a precious metals project to have the money available to do the work required, but at the same time, they don't want any new shares issued. So that's not a reality. So let's talk a little bit about what is dilutive and what is accretive. If new equity coming into the business, coming into the company, allows the company to advance assets, to remove risk, to validate a geologic concept, to perhaps acquire a new and exciting project, then the company is adding value, and the likelihood, particularly in a rising precious metals environment, the likelihood is that that company will be revalued. And accordingly, we would look at that financing as accretive. Where we get dilution is, and I really don't want to get into a discussion about lifestyle companies because they're a pet peeve for me. They're a pet peeve because they give the rest of the business a really bad reputation. Most of the bad actors who are running lifestyle companies are in a very small minority. As I've said in earlier videos, the nature and quality of the entrepreneurial talent, of the marketing talent, and of the geoscience and engineering talent in the junior space is unprecedented in my 45-year career. I have never seen the space populated by so many good players, and yet you constantly hear about lifestyle companies. So what's a lifestyle company? A lifestyle company is one where the company president or the insiders pay themselves an exorbitant amount of money for doing very little. For you investors out there, it's really easy to determine what insiders, what management groups are taking out of the company. In both the financial statements and the management and discussion and analysis paper that accompanies financial statements, there are the related party transactions. And you have to disclose also any material management contracts. All that stuff is available. And if you find a company where the CEO is paying himself more than half the annual budget of the company, I can pretty much guarantee you that that is a lifestyle company. Or when a company is raising, say, a small amount of money, $500,000-$600,000 up to $1 million, and the bulk of that money is going to G&A, is going to overhead, management fees. That's a lifestyle company. Turn on your heel and run as fast as you can in the opposite direction. I'm not giving investment advice here, but really it gives the whole space a bad name. Those financings are dilutive because no new value is being added. Let me give you a not quite specific example because I'm not going to talk about the name of the company, but I did do some videos back in the mid and late spring when the market started to look like it was percolating a little bit, and I did mention, because of the Ainsworth Silver Project and Goldcliff's keen interest in silver, I did mention that on up volume days on the TSX Venture Exchange, the number of leading traders that were silver issuers caught my attention, and I did share that with our YouTube audience. One of those companies kept showing up, and the price really wasn't appreciating, but it was doing a lot of volume, and I'd kind of recognized the name but forgot about it. So I looked into it. And what I saw was a one asset junior producer that was losing a lot of money. The mine operating costs exceeded the revenue, and it was not a good looking income statement. The balance sheet was even worse. Not only was there debt on the balance sheet, but the trade payables were 3 or 4 times the amount of cash in the bank. Why is that important? Well, because you have to make payroll, usually twice a month. And if your suppliers get ticked off at you to the point where they demand cash up front, for example, your explosives provider or the local provider of power that's running your mill, that's a really squeezed position to be in, and that's where this company was. And so I looked at it and I go, why would anybody buy this thing? Well, because the silver investor was looking at it and saying, yeah, these guys are losing money, but if silver goes up a couple bucks an ounce, they're going to be breaking even. If it goes up a little bit further, they're going to be making some cash flow. That company did a financing, a big financing, at least $20 million. Now, this is a stock that was trading under 50 cents, so they put out a lot of new shares and added to an already high share count. So you go, wow, why would you dilute like that? But what did that capital do? That capital cleaned up the balance sheet, and now the income statement, which looked terrible, looks pretty good. That company's making cash flow. Needless to say, it's been revalued and will probably get revalued again. So here is a situation where it didn't look good going in. The operation was losing money. It owed a lot of money. It looked like, frankly, a candidate for bankruptcy. However, in the rising metal environment, it caught that leverage. And so that money was highly accretive, because now those financial statements, especially for the period reporting the time that we're just coming through with record silver prices, that income statement and that balance sheet is going to look terrific. We're not buying these things for cash flow per share or earnings per share multiple. Most investors aren't, that are coming into the silver space or the gold space. So they're not caring so much about that, but what they are caring about is the financial flexibility that that company now has. Perhaps there's zones within the deposit that were a little bit lower grade or marginal, that now they can sink the development in because they'll now make money off those, or perhaps there's an acquisition that they can fund out of internally generated cash flow. There's a number of opportunities now available to the company. If you take that down to the Goldcliff stage companies, early exploration companies, a little bit of money, a little bit of new capital, coming in, yes, at low share prices, yes, you could say dilutive, but any sniff of value as a result of the work that that money finances, there's a serious revaluation. And again, you get that tremendous leverage in a rising precious metals environment, which is exactly where we are and is probably the best explanation for why the financing window has opened up and looks like it will continue to be open at least for the near term. So just wanted to share those observations, and particularly talking to the new investors or the investors who for whatever reason derive most of their information from social media and other online platforms. Not all financings are dilutive, and indeed many of them are highly accretive because they allow management some flexibility and they allow management to add value to the assets. Stay tuned for more videos on the Goldcliff YouTube channel, and thank you for your time.